Good morning and welcome to the Prescient Investment Management Equity Webinar for Q4 2022. My name is Natalie and joining me today I have Bastian and Seeiso. 2022 was a year to remember, and now for equity markets globally, certainly one to forget. Inflation was a dominant force driving markets, surging to near record highs in recent times in the US, leading us into an unprecedented series of interest rate hikes and ending the equity bull market that lasted for more than a decade. After a brutal year, the fourth quarter of 2022 experienced a slight reprieve. Could this be a sign of things to come? So let's jump straight into that. Basti, can you take us through our global growth expectations for 2023?
Sure, Natalie, and also welcome everybody back to 2023 from my side. So yeah, for 2023, I guess most economists globally have resigned on the fact that growth is going to be below trend, probably quite slow globally, and we are kind of in the same boat, have the same expectations. Unfortunately, we are coming out of basically 2021 being a year of more than 6% economic growth in the States, and then we started to lose momentum. 2022, a year of just below 2%, and now on this very low momentum we are entering 2023, so one shouldn't be surprised. We also shouldn't be surprised if I just look at the circumstances. We have been, as you said, we have been through this super steep hiking cycle, and it takes a while for financial conditions to tighten and for high interest rates to work their way into the system. But normally we say 12 to 18 months, and this is where we are now. So with that, obviously, we should expect the global economy to slow.
Okay, so not sounding very positive, but I know we have a lot of data that we can dig into here, so maybe you can show us some evidence as to why you are pessimistic on global growth right now.
Yeah, certainly. I mean, we generally prefer to show the Prescient Economic Indicator. The Prescient Economic Indicator is our own in-house nowcasting. So we compress more than 100 million data points at Prescient generally on a daily basis, but what we do in this instance is that we use more than 100 time series which we compress, we filter out all the errors, and we identify a common trend. Okay, looking at the indicator, we can see that we have seen as of recent quite a bit of a decline, but I actually want to zoom in a little bit and put it into context. So you can see that here we have the indicator picking up basically the burst of the dot-com bubble in the early 2000s. It picks up the great financial crisis here in 2007 quite early. And we keep on zooming in. We'll see that it also picks up the COVID crisis quite timely. So basically March, Feb 2021, we already see the crash hitting us. And that means it's a good model to predict where the global economy is going. Where are we now? So you can see we have dropped quite a bit below trend. So by all means, we are already experiencing quite slow growth. I mean, look at the last data prints. The labor market's still strong, but other than that, we see weaker industrial production, weaker retail sales. A lot of data prints are coming in weaker and weaker. And we can also use alternative measures to just looking at global trend growth. We can also look into economic surprises. Also an indicator set which we enjoy to use, where we're basically measuring whether economic releases are coming in better or worse than initially expected by global economists. Zooming in on that as well, you can see that we're dropping below the zero line. So not by a wide margin, but all of this is just telling us, yes, we are already growing below trend growth, and yes, the global economy is slowing down. But on top of that, we can now also say that economic surprises are experienced on the downside. Quite a lot of pressure, and given that this is an equity seminar, I also want to speak quickly about profit margins. Profit margins in this context, not what it means directly for the equity market. I'm going to cover that later on as well, but we use profit margins here as well as an indicator for the global business cycle. So you can see that normally at the end of the business cycle, the corporations reach their peak level of profitability. And then as we head towards a recession, profitability comes off. And as we speak, the S&P 500 is most representative for the global business cycle because it holds the most global corporations, has already experienced quite a drop from its peak. So still high profitability across the US equity market, hence elevated PE ratios are potentially to some degree explainable. but you have definitely experienced rolling over here, which means the business cycle is once again coming to an end.
Thanks, Basti. So potentially lower growth in 2023. But let's chat about a scenario where we see a pivot in global monetary policy. This could be quite a strong driver of asset class returns in the upcoming year. Is this something that we could expect to see soon?
Something we potentially, to some degree, a lot of hedges in my statement, what one potentially could expect. And I have to say that because we have already fully priced for that. So that actually creates more worries for us than expectations, because yes, there could be once again a Fed put, so to say, the Fed jumping to a help once the economy rolls over. But the reality is the market partly has priced for that. We have covered that extensively in our fixed income seminar. Don't want to go too much into detail, but I do want to show some of the inflation dynamics because they explain quite a bit why the market is hopeful for the Federal Reserve to once again ease financial conditions. So when speaking about inflation, and I must admit we have spoken about inflation so much last year, but we have to not just look at the trend, we have to understand the drivers of inflation, and it is just absolutely crucial to understand what the ability of the Federal Reserve will be to potentially ease interest rates or lower interest rates and ease financial conditions or not. So what we're showing in this chart is basically just very simply the trend of inflation through time. You can see that we have seen peak inflation basically in June 2022 at 9.1, almost the highest level since the late 70s. But since then we have now seen a stock decline. So that's good, and that made the market hopeful that there is room for the Federal Reserve to once again ease financial conditions. Unfortunately, it's not all that easy, so we need to really look a little bit more detailed. What we like to do is we like to decompose inflation. I'm going to do it in this chart where we basically drill in to the individual drivers of inflation. And we like to think about inflation as like a three-layered conundrum, so to say. Starting on the very outside, you've got elements like commodities, the fuel price, potentially energy costs in Europe. When you go one layer in, you can see stuff like the goods which are potentially produced from these commodities, so like call it used cars or new cars, other consumer goods, etc. And then we have a core at the very heart of inflation. At the core there would basically be something like shelter, which is heavily driven by for example, wages and the strong labor market. Okay, let's start to look at these individual buckets. I'm going to start by looking at motor fuel as a good proxy for the oil price because it enters the CPI basket and it's directly linked to the oil price. You can see here at peak inflation we had a contribution of more than 2% just from the oil price. Quite a high contribution. And since then you can see that the oil price has come down, and the contribution from the oil price now is just 0.68%, so much lower contribution. So the first layer of inflation is clearly coming down. Okay, let's look at the second layer. Second layer, I would like to look at new and used motor cars or motor vehicles. You can see peak inflation, we've got a 1.7% contribution. That came off since then quite remarkably down to almost next to nothing. So 0.27 is the contribution now, and it's going to go down further. So the first and the second layer of inflation clearly are on the way back, which means potentially there's room for the Fed to ease. But what about the last layer? And that's what we have to observe more carefully. Let's look at shelter. So shelter is basically closely linked to house prices. And here you can see at peak inflation, roughly, we've got 1.76% contribution to the CPI basket. And what has happened to the price of shelter since then has actually continued to climb up. So if you follow the numbers, we right now have the highest contribution from shelter, which we had over the last couple of years. So yes, inflation coming down, but there are concerns to it. We expect shelter and the housing market to come down when it comes to its prices as well, because we see a lot of cracks emerging and the higher interest rates targeting the housing market. But it will be a while, so it will remain interesting how quickly the Federal Reserve is going to be easy to basically potentially pivot away from the tighter level of monetary policy.
So the outlook's looking pretty grim. Inflation is still too high, but we're still positive on equities. Can you expand on this a bit?
Yeah, inflation is too high and economic growth is slowing, but it's not all that terrible. So as said, inflation is on its way down. Yes, it might be more sticky, but as we speak, it is coming down. And global growth, yes, it's weakening, but as shown, our present economic indicator is not predicting a particularly deep recession right now. And I want to say that actually we're not that positive. We are positive on SA equities, but on equities as a whole, we are actually taking a quite cautious stance.
So where are you seeing that there is more value in SA equities then than other equities? Maybe you can show us this.
Yeah, more value is exactly the key word. So it comes down to the value factor. So we use a set of 4 factors for the assessment of all the asset classes. And for equities, as I said, like from a macroeconomic point of view, generally there's a lot of headwinds and financial conditions are tightening. So how can you still be positive on equities? Well, we're not. We're only positive on those equities which have very strong value scores. Okay, so when looking at the screen, we can see that on most of the riskier asset classes, i.e. equities, we are more on the left-hand side of the screen. So we rank the asset classes here from strongly negative on the very left to strongly positive on the very right. And you can see a neutral in the middle, and where we just have developed market small caps as a little bit of a niche asset class. But then everything else, excluding SA equities, we are actually pretty negative. So we are taking a cautious stance in a measured way as always, but we really just like SA equities. Let me drill into US equities a little bit more detail to basically show you where that negative stance is coming from. I mentioned financial conditions not super tight yet, but tightening, and then those economic headwinds which we spoke about, and then valuations being super negative on US equities. To contrast that to South Africa, I see a quite different story. So here you can see that in South Africa we have equally strong, some or not as strong economic headwinds. We also have financial conditions which are just average but tightening. But the massive difference here is that we have a quite attractive valuation score. So valuations in South Africa really, really looking good. And if I drill into that a little bit more detail, you can see that the different scores or ratios which we use to assess the South African equity market. And you can see that from price to earnings over price to book all the way to price to sales, they mostly are well priced. Price to earnings, so good earnings in SA standing out. And also our last factor at the bottom there is interesting, where we see a relative earnings yield. So that's basically our PE ratio being much lower than the PE ratios in other equity markets, and that's obviously also quite supportive. So long story short, we do take a cautious stance on equities. We do acknowledge the headwinds, but we are remaining quite positive on SA equities, and SA equities really the place to be right now when it comes to equity markets.
Thanks, Basti. So in our last webinar, you took us through the portable alpha strategy and explained how the performance of the strategy is dependent on the dynamics of the short-term fixed income market. So given how the fixed income environment has changed over the last year, I think it would be beneficial if you could maybe just give us a brief recap on how these dynamics work.
Yeah, thanks Natalie, and thanks everyone. It's always worth recapping why we're so focused on the fixed income market, particularly in an equity webinar. And the reason is because the portable alpha strategy primarily is a alpha and beta separation strategy. So it is specifically designed to separate the drivers of return, whereby we have passive equity exposure, so that's the beta, but any relative return over and above the market is purely derived in the fixed income market. So Basti just gave a comprehensive view of what we think about the equity markets, but if we're going to talk about how the relative performance, whether we do better or worse than the actual equity markets, we have to delve into the fixed income space, because that is the alpha engine.
Okay, so we know last year was a particularly challenging year for the rates market. So how did this play out in the Prescient core equity funds? Maybe you can just take us through the positioning of the funds over the last quarter and how this translated into the performance of the funds.
Yeah, we all know that it was a particularly choppy year, the 2022 calendar year for interest rates for a variety of reasons, but this was definitely the most volatile period in terms of the portable alpha strategy's relative performance. And I think a bit of context is always worthwhile here. So if we think about where, the backdrop, the macroeconomic backdrop, we had this massive global pandemic in 2020, which led to unprecedented levels of fiscal stimulus, so cash being pumped into the system, and this incredible easing of monetary conditions globally. And that's all a result of the lockdowns and the economic impact that the lockdowns were having. And then obviously the natural feed through from that is inflation then ticks up, because all of a sudden people have all this cash. But we've always maintained that the reason inflation was ticking up has always been because of, rather than demand driven inflation, it's been supply side bottlenecks that have been running, that have been pushing the inflation upwards, and which is exactly what we saw in 2021. And then in 2022, we started off the year quite well, and then you had this incredible shock to the energy markets with the Russia and the Ukrainian conflict, which sent oil prices skyrocketing and brought about this debate whether inflation is indeed transitory or whether it's becoming entrenched. And you double that with very tight labor markets, where that fiscal stimulus and easy monetary conditions were prevalent. The fear then became that sort of horrible scenario of a wage price spiral, whereby the labor force starts demanding higher wages from the employers, and then employers have to pass that on to the consumers, and then inflation just spirals out of control. And monetary authorities then went on this all-out war against inflation, which again has been talked about for ages, but we saw the steepest rate hiking cycle that we've ever seen, and that's what made it so choppy for the fixed income markets. As to what it meant for the performance of our funds, that is better illustrated with the chart. As mentioned, the 2022 calendar year has been by far the most volatile. You can see it here, the relative performance shown cumulatively. If you compare it to any other year, you can see that we saw some of our deepest drawdowns and also our steepest recoveries during 2022. And the reason being that it's been the steepest rate hiking cycle, and our positioning going into this, and of course with hindsight, was perhaps too optimistic. We've always been of the view that inflation is indeed transitory, and given what was priced into the markets in terms of rate expectations, there was an implausible amount of rate hikes that were priced into the markets on the back of this stubbornly high inflation, and we took on term risk relatively early on, but subsequently inflation proved to be stickier than we anticipated, and rate expectations continue to go up. As rate expectations go up, we suffer negative mark-to-market losses, and we saw the worst of them sort of in June and here again in September, but we saw subsequent recoveries. Investment thesis has always been that fixed is better than floating, given the steepness of the front end of the yield curve.
So you mentioned that rate expectations eased a bit. Can you maybe unpack that a bit more for us?
Yes, I can, and I think it's probably best to do that visually. We can pull up the chart. So what we have here is the very front end of the yield curve at various time points, and what I want to do is just build it up slowly, starting from what the very front end of the yield curve looked like 2 years ago. You can see there was this gradual rise in the yield curve compared to 6 months ago, which speaks to the excessive pricing in of rate hikes. You can see it was incredibly steep. and even steeper 3 months ago. But compare that to today, you can see there's been this massive flattening, particularly between 3 months ago to today. So this is indicative of the market now, in fact, pricing in moderate cuts in interest rates going forward. And of course, given our positioning, this has led to a positive or an uptick in our relative performance.
Thanks, Seeiso. So given these recent market movements, have you made any changes in the positioning in the portfolio? Are you still seeing the potential to generate outperformance? And can you also take us through any potential risks to your outlook?
Yeah, that's a great question. Yeah, so I said we've seen quite a drastic shift in the very short end of the curve, and primarily or the bulk of our expected outperformance has been due to taking on term risk. What these recent changes have done is essentially just made it less attractive to take on term risk than what it was 3 months ago. But that does in no way mean that there's still no pickup over funding rates in taking term risk. It's just that it's not as clear cut as it was before. So what we're doing now is we obviously weigh up the potential pickup from taking on term with the associated risk. There's a specific chart that I think is quite illustrative of this that I'd like to bring up. Okay, so what we have here is essentially the spread through time between a 1-year fixed rate NCD and 3-month JIBOR. 1-year fixed rate NCD being indicative of the amount of yield that we're able to obtain if we invest in a fixed rate instrument for 1 year, and 3-month JIBOR being indicative of our funding levels. The difference between these two is exactly what you're asking about, Natalie. What is the potential for outperformance? And as you can see, it's charted here in gray. There's still a significant amount of outperformance. It has come in over the last quarter, and the portfolios have definitely benefited from this compression in this relative spread. But it's still clearly very positive and still above average. So all this to say that yes, even though we've had this favorable uptick in performance because of the flattening of the yield curve, it hasn't flattened so much that we are at a stage of returnless risk. So if we weigh up the risks which we measure in terms of tracking error relative to the spread that we're able to get alpha, then we're still in a position to generate significant outperformance from our fixed income positioning going forward.
Okay, so you mentioned that term risk is not the only way to generate outperformance.
In addition to the term risk premia, which is essentially investing our clients' money for favorable periods of time, we do have at our disposal the credit risk premium as well, which we can harvest, and all that entails is simply investing in high yielding floating rate instruments, which we're moving towards now since the term risk is not such a no-brainer anymore, and this is consistent with how we've previously managed to generate the favorable performance that we've come to provide for our clients over the years. So in terms of future outlook and whether we are still able to generate significant pickup over funding rates, we're simply now considering we're simply now moving towards a different type of risk premia than was before, but it's part of how we generate the yield and how we've always generated the performance.
That's definitely sounding very positive. So you have mentioned before that there are some new innovations in the pipeline. So can you maybe give us a brief update on our product offering? Are there any new and exciting things that we can look forward to?
Yeah, certainly. We'll always jump at any opportunity to talk about the funds. So what we offer this strategy across multiple local indices and global as well, in unit trust vehicles and the segregated funds. Our two most notable changes to our product offering is one, the addition of our Prescient Core Global Emerging Markets Fund, and that is offered in the UCITS regulatory environment offshore, and is alongside our Prescient Core Global Developed Market Equity Fund. Locally, we have launched the Prescient Equity Fund in December, and instead of being benchmarked to a specific index, this fund is benchmarked to the average of the Seeiso General Equity category and is managed dynamically to essentially mirror the category average as a benchmark and then apply the portable alpha strategy.
Okay, so it's interesting that you say it's quite dynamic. So can you explain to us how it's positioned then?
Yeah. So this fund is actually quite interesting in that the beta itself, or the equity market exposure, is not static. Unlike our, a core all share fund or a core capped SWIX fund where the beta is a specific benchmark index. With this particular fund, we dynamically every day extract the beta from the average of the aggregate holdings in the South African local equity landscape. And what it does, it gives a good sense of what in aggregate the fund managers in South Africa are holding, and perhaps we can drill a little bit deeper into how we're currently seeing the landscape. As mentioned, we can quite robustly and quantitatively extract the overall allocation across the sector, and then apply portable alpha on top of that to generate above category average returns. Perhaps the easiest way to do this is to look at the allocation via benchmark index. And as we can see, the current allocations show that of the funds in the local equity category, 72.6% of them currently hold an allocation benchmarked to the SWIX, and then 2.3 kept Aussie, and then 20.3 Aussie, finally about 4.4% holding the SWIX. If you basically combine all these indices in these exact weightings, then you get to a very close estimation of what the aggregate of the South African equity market is holding. The great thing is we can also, in addition to looking at how this has changed through time, we can additionally drill down into a particular, into a share level exposure, and also at a sector level to get a sense of what everyone is holding, and then of course apply portable alpha. And the great thing is that this is done dynamically every day through time, and hence we're able to deliver above category average returns.
Great, thanks for explaining that. So just before we end off, do either of you guys have any closing remarks?
I'll perhaps just add on to say that, listen, as Basti said, from a beta perspective, we're cautiously optimistic, particularly in the SA equity context. From an alpha perspective, we had a very choppy year last year, but for valid reasons, and eventually our investment thesis played out. We saw this massive steepening of the front end of the yield curve, and that brought about the performance to close off the year still above benchmark. And then from a product perspective, we've finally managed to add these two developments, and we are confident, given the way that 2023 has started, that it's going to be a good year for the portable alpha strategy.
Yeah, it's always good to start on a high note with a lot of alpha straight already in Jan. But I guess the more important point to make is really that we have really been through a lot last year with the portable alpha process in terms of refining the engine, making sure that it can stand the test of time, and especially with what we've seen in markets, steepest hiking cycle since the 70s, and you come out in the positive with the portable alpha strategy. That means we are feeling quite bulletproof and really ready to hit it hard this year. And SA equity is still cheaply priced. We've got the right product, so quite optimistic on this one.
Basti, Seeiso, thank you so much for your time and all of your insights today. Thank you everybody for joining us. We will take some questions now. Good morning again. Thank you for joining us, and thanks for sending through your questions. We're just going to jump straight in. So our first question we have today: what are the bigger macroeconomic risks which you see for the strategy going forward?
I'll take that one. I would argue the biggest risk that, as we've outlined in the slides, is that the Fed eventually could end up keeping interest rates higher for longer, or potentially even go beyond the likely, but it is obviously one of the key risks which we have to highlight, i.e. just tighter financial conditions compared to what is priced right now. Another big risk would obviously be on the geopolitical front, where we have a lot of, I want to call it trouble, but there's a risk that the situation around China and the US obviously escalates, which once again could lead to stronger reinforced trade wars and then just slower global trade and a slower global economy. And last but not least, maybe just a deeper recession. As I mentioned, our data doesn't really track that yet, but there is a risk that we roll over in a faster fashion than initially anticipated, and that we then would see a deeper recession, which would obviously be negative for equities. All of these are not our base cases. So especially for SA equities, we mentioned we are quite well priced right now, so we'd remain bullish on that asset class for now.
Thank you. Here is a fun specification. What challenges are there in running the equity strategy offshore when compared to locally? What do you need to change in the process to offer the offshore versions?
Okay, so I'll take that one. So in the offshore space, I mean, the strategy at its bare bones remains the same. It's still equity market exposure with fixed income or cash alpha. I think the key differences in the offshore space are, from the equity side, the global indices are quite deep and quite liquid indices with deep derivative markets. So we find it a lot easier there to get synthetic exposure on these indices. Therefore, there's no need to have any physical at all. So if anything, it makes it easier for us to run these strategies offshore. And then on the cash side of things, once we've got our synthetic exposure to the equity market, these offshore funds are under the UCITS regulations, and we find that there's what cover represents, or what cover is defined as under the UCITS regulations, is perhaps a little bit more liberal than locally. So locally, for instance, Board Notice 90 is very specific about the types of instruments that we can utilize to express our views, whereas in the UCITS space, it's a little bit broader, and the key consideration there obviously being liquidity, and being able to at the drop of a hat to be able to fund any negative mark to market on the equity side. So there we have a much broader universe of instruments that we can use, and we have a more advanced optimization tool, which we employ. So we take every single instrument that is allowable to us, and we run it through an optimization process where we are optimizing yield for tracking error, and we come up with an efficient frontier, and then we have a really robust risk indicator, which we then use to dynamically move between different points on that efficient frontier. So if anything, I think the offshore space is a lot easier for us to implement this. It's further ahead as a result of the markets being deeper, the instruments being more liquid, and also the regulations allowing us to express our views a lot more than locally.
Great, thanks. Next question. How has the rising rate environment affected the funding costs on the derivatives? Have the costs also been increasing?
Okay, so I'll take this one as well. So we've had obviously rates going up sharply last year, and yes, it's a good question because there is a funding cost element to these funds, but remarkably we've actually seen our funding costs, which is the spread over 3 months JIBOR that we pay for our derivative exposure, that's actually been coming in over the year, and it's the counterparty banks that we deal with are all attributing it to changes in the South African Reserve Bank's implementation, monetary policy implementation framework, which has made it which has made the banks cash flush. So they're finding it easier to get money out of their treasury. And a good example of this was this past December. So December typically is quite a we see a spike in funding costs, but this past December we saw the softest funding spreads throughout the year. So it's a nice indication that funding costs have been coming down. And this is, of course, is a good thing for our funds because it means we have locked in, higher spreads, and we're seeing our funding spreads come down, which means that the carry, the portable alpha that we're able to generate, that spread opens has been opening up. So going forward, it's looking good, and with funding costs hopefully continuing to come down, looking even better.
Thank you. Okay, this is our last question. You mentioned that you have been through the steepest hiking cycle over the last 30 years. How did the strategy get out of this, and how do you know it won't happen again?
I'll take that one.
Okay.
We have been through the steepest hiking cycle over the last 30 years, it's true. And how has the strategy behaved? Well, the strategy has done what it's supposed to do. We came out pretty unscarred. I will not say totally unscarred because we have, it was volatile. Our tracking error moved above 1%, which for us is quite high. I guess for other active managers that would be seen as pretty low, but for us that's quite high. But you would expect that because it's not just us taking risks, it's interest rates moving quicker, which feeds through to tracking error. And that's what we've seen, but not in an excessive way. And most importantly, we ended the year on a positive note with positive alpha. So again, positive alpha, I will say that, positive alpha over all measurement periods now, all the relevant measurement periods. So we're feeling quite strong. And let's face it, for an interest rate linked investment strategy like this one, a very steep interest rate shock is the biggest test which you can put the strategy through. And we have ended the year on a positive note. So just speaks towards our conservativeness in our approach to this very cautiously bit by bit engineered alpha, which makes us really superior to a pure passive, because you get something in terms of alpha even after fees. And we know how difficult it is in the equity space to beat your benchmark. According to our numbers, 80% of peers do not beat their benchmark after costs, and we do so consistently. So once again, good signal that the strategy is working out really, really well. So why does it not happen again? So why don't we see such a hiking cycle again? Well, you can always see such a shock again. We don't think it's likely. You remember the Fed at the front end is now at 5%. And it is an economy which long-term drifts towards 2% inflation. So where do you want to go from here? Yes, you could see rates go from 5 to 6, 7, 8, but I do think it's not realistic. So all in all, we've been through the test. We've been put through the test. We survived it quite nicely, came out positively, positive alpha once again. So I guess, the strategy looks stronger than it has ever looked before.
Thanks, Basti. Thanks, Seeiso, for answering all the questions today. And thank you, everybody, for joining us. We hope you have a great day further.